The Monetary Policy Committee, MPC, met on the 23rd and 24th of May 2022, confronted with declining global growth and heightened uncertainties associated with adverse price developments across the world. These developments partly reflect the aftermath of the ongoing war in Ukraine, the backlash from the numerous sanctions imposed on Russia by major advanced economies, as well as persisting supply chain disruptions in major trading routes. This video shows the highlights of the MPC decisions and impact of these decisions on the Nigerian capital market. The key macro factors noted by the committee in the advanced economies include the following. Global monetary policy tightening led by the US Fed and the Bank of England to curb rising prices. Unabated rising inflation rate due to a combination of persisting high food and energy prices, supply chain disruptions associated with the impact of sanctions against Russia. Burgeoning global private and public debt portfolios due to huge amount of stimulus deployed by various countries to ease the downsides of the COVID-19 pandemic, particularly in 2021. Downgraded forecast for global growth output for 2022 and 2023 to 3.6% from 4.4% by IMF. Spread of a new wave of the COVID-19 pandemic within major industrial cities, resulting in a slowdown in production. Gradual restoration of investor confidence in financial markets leading to rising demand for advanced economy equities and bonds. Concerning the domestic economy, the committee also noted that real gross domestic product, GDP, grew by 3.11% in the first quarter of 2022, compared with 3.98% in the fourth quarter of 2021. Headline inflation, year-on-year, ticked up to 16.82% in April 2022 from 15.92% in March 2022, 90 basis points increase. Interbank call rates increased to 8.67% in April 2022, from 4.50% in March 2022. Broad money supply, M3, rose significantly to 6.22% in April 2022, compared with 4.19% in March 2022. Naira depreciated against the US dollar from 418.33 in April 2022 to 419.50 in May 2022, indicating pressure on Naira. Gross external reserves declined moderately to $38.36 billion as at May 19, 2022 from $39.28 billion at end March 2022. After carefully reviewing the developments of the last 2 months and the outlook for both the domestic and global economies, as well as the benefits and downsides of each policy option, the committee decided to raise the MPR to 13.0%. Retain the asymmetric corridor of plus 100/700 basis points around the MPR. Retain the CRR at 27.5%. And retain the liquidity ratio at 30%. The table shows the snapshot of equity market before and after the MPC meeting. From the data, the equity market displayed strong resilience after the initial shock of capital flight following MPC rate hike. Sustaining this upward momentum would largely be dependent on the level of domestic investors' participation in the market. The table shows the snapshot of FGN bond market before and after the MPC meeting. The long-duration bonds were hard hit by the rate hike as their yields inched up after the MPC meeting. Factors responsible for the upswing in yield may include profit-taking by investors, search for positive real rate of return resulting in bonds sell-off, capital flight by FPIs. Food for thought. We have itemized key market expectations and their likely impacts in the short to medium term as follow. Number 1. As 2022 is a pre-election year, expect huge spending for political campaigns and events. The likely impacts on the domestic market include excess liquidity, high inflation rate, speculative FX trade. Number 2. Possibility of interest rates hike by central banks around the world. The likely impacts on the domestic market include Capital flight in the domestic capital market. Weak exchange rate as inflow of foreign currencies dwindle. And tightening monetary policy to attract foreign investors in high inflation rate. Number 3. Rebalancing of portfolios owing to expected interest rates hike in the developed economies. The likely impacts on the domestic market include continued sell-off as risk-averse portfolio investors reassign their portfolios, from perceived riskier emerging market securities, to less risky advanced economies with the expectation of improved yields. Thanks for watching. Watch out for our next edition.